Welcome back, everyone. If you've been watching the silver market lately, you already know that something significant has been happening. Prices have been moving in ways that are making a lot of investors uncomfortable, and that discomfort is completely understandable. When you see an asset you believe in suddenly drop sharply, the natural reaction is to question everything. Is this the beginning of something much worse? Or is this one of those rare moments that experienced market watchers look back on and say, that was the moment everything changed? That is exactly what we're going to dig into today, because the answer isn't simple, and anyone who tells you it probably isn't giving you the full picture. What we're going to do in this video is look at silver's crash history with clear eyes. We're going to examine what happened during the major silver price collapses of the past, what caused them, how long they lasted, and what eventually followed. Then we're going to compare those historical patterns against what's actually happening right now in 2026, because the structural foundation of this market looks meaningfully different from anything we've seen in previous downturns. And that difference matters enormously when you're trying to figure out whether this moment represents a trap or an opportunity. Before we go any further, nothing in this video is financial advice. This channel exists to help you understand markets better, to give you frameworks and information so you can make more informed decisions on your own, ideally with the guidance of a qualified professional. What I'm here to do is explain, not instruct. With that said, let's get into this. To understand where silver is right now, we need to understand where it's been. Silver has a genuinely dramatic crash history. This is not a gentle asset. It never has been. Silver is famously volatile, far more so than gold, and that volatility cuts both ways. The same characteristics that can send silver surging 60 or 70% in a short period are the same ones that can send it falling 30 or 40% just as quickly. So when silver drops hard, panic is easy. But context matters enormously. The most legendary silver crash in modern history happened in 1980. In the late 1970s, the Hunt brothers attempted to corner the silver market, accumulating enormous amounts of physical silver and futures contracts and pushing prices from roughly $5 to nearly $50 an ounce by January of 1980. Then the exchanges changed the rules. Margin requirements were dramatically increased. The brothers couldn't meet their margin calls, and the whole structure collapsed. Silver fell from nearly $50 to around $10 in just a few months, an 80% collapse. That crash was entirely manufactured, the result of artificial manipulation, with nothing to do with real supply and demand. When the manipulation unwound, prices snapped back to reality. Fast forward to 2011. This one is closer in memory and worth looking at carefully because the emotional dynamics feel similar to what investors are experiencing right now. In the aftermath of the 2008 financial crisis, silver began a dramatic multi-year rally. Quantitative easing, fear of inflation, and a flight toward hard assets pushed silver from under $9 an ounce in late 2008 to nearly $50 by April of 2011. Then, over just a few weeks in May, silver lost nearly 30% of its value. The CME Group raised margin requirements 5 times in about 9 days, and the market simply broke. By 2015, silver had fallen all the way back to around $14 an ounce. Here's what's critical about the 2011 crash. The rally that preceded it was largely driven by financial flows, speculative positioning, ETF buying, and investor sentiment, rather than a fundamental transformation in physical demand. When sentiment shifted and margin costs rose, the speculative layer dissolved. The underlying physical demand wasn't strong enough to hold prices at those levels. We're going to come back to that point when we look at 2026, because it's one of the most important distinctions in this entire conversation. In 2013, the Federal Reserve, hinting at tapering its bond-buying program, sent precious metals sharply lower. Silver moved from around $30 to nearly $18 within months. This was primarily a financial market event, investors reassessing inflation and monetary policy, pulling money out of precious metals and into assets that benefited from stronger growth expectations. Silver didn't have enough structural support to resist that macro headwind. And in 2020, at the very start of the pandemic, silver briefly collapsed from around $18 to under $12 in March before staging a remarkable recovery to $29 within months. That was a pure liquidity event. When global markets went into free fall, investors sold everything to raise cash. Gold, silver, oil, equities all fell together before central banks flooded the system with liquidity and prices recovered fast. So what do we actually learn from this pattern? A few things stand out very clearly. Silver crashes are rarely slow. They tend to be sharp and sudden, driven by forced selling, margin pressure, policy shifts, or unwinding speculation. The crashes that took silver the furthest and kept it there the longest were the ones where price had been driven primarily by financial speculation rather than genuine physical demand. And the recoveries, when they came, were often faster than people expected, particularly when structural conditions in the underlying market had changed. That last point is especially relevant right now. And this brings us to 2026, because the structural conditions in the silver market today look genuinely different from those prior episodes. Let's talk about where silver's demand actually comes from now, because this is where the story gets interesting. For most of silver's history, the picture was relatively straightforward. Jewelry, silverware, photography, some electronics, investment demand. Photography demand collapsed as digital cameras took over, a major headwind for years. But something has been building quietly over the last decade that has fundamentally changed the demand landscape, and it has everything to do with the global energy transition. Solar energy is now one of the most significant and rapidly growing sources of demand for silver in the world. Every solar panel contains silver. Silver paste is used to conduct electricity in photovoltaic cells, and the efficiency of modern panels depends on it. Solar installation capacity has been growing at a pace the market wasn't prepared for a decade ago, and projections for expansion through the end of this decade suggest this demand is not going away. It is structural. It is embedded in long-term infrastructure investment cycles that governments and corporations are fully committed to. Then you have the electric vehicle industry, where silver is used in battery management systems, charging infrastructure, circuit boards, and electronic components throughout modern vehicles. And beyond EVs and solar, silver plays a role in semiconductors, 5G infrastructure, advanced medical devices, and a range of high-technology applications that are growing in importance, not shrinking. Now, this is important because it changes the character of the demand supporting the silver market. In 2011, if financial sentiment shifted and speculative money left, there wasn't a deep enough base of industrial consumers urgently needing physical silver to hold the price. That industrial base has grown substantially since then, and crucially, industrial buyers don't operate on sentiment the way financial investors do. A solar panel manufacturer doesn't stop buying silver because the price chart looks bearish. They need silver to make their product. Their production schedule demands it. Think about it this way. If you're a manufacturer producing hundreds of thousands of solar panels every month, silver is a raw material you need regardless of what's happening in the investment community's mood toward precious metals. You might hedge your costs, you might optimize inventory timing, but you cannot stop buying silver and keep making solar panels. That's a fundamentally different type of demand than what was driving price in prior cycles, and it matters enormously when analyzing the current correction. So what is actually causing the current weakness? Because the price hasn't been moving lower in a vacuum. There are real forces at work. One major factor is the broader macro environment. When interest rates remain elevated, or when markets believe monetary policy will stay restrictive longer than expected, that creates real headwinds for non-yielding assets like silver. silver doesn't pay a dividend or a coupon. When you can earn meaningful yield on cash or bonds, the opportunity cost of holding silver rises for financial investors. That was a major driver in 2013, and it's relevant in any environment where rate expectations are shifting. Another factor is dollar strength. Silver is priced in dollars globally, so when the dollar strengthens, buyers in other currencies face higher effective costs, suppressing demand on the margin. There's also the role of futures markets and paper silver. The silver futures market is enormous relative to the physical market, and positioning in futures can drive short-term price action in ways that diverge meaningfully from physical supply and demand. When large institutions build substantial short positions in silver futures, they create downward pressure that physical demand alone cannot immediately offset. This is a real feature of how silver is actually priced in practice. When you see silver fall sharply and quickly, it's always worth asking what's happening in the futures market alongside what's happening in physical demand, because the two can tell very different stories at the same time. Here's where things get genuinely interesting. There has been a growing tension between the paper price of silver and the premiums being paid for physical silver in the real world. When you go to buy actual physical coins or bars from reputable dealers, you often pay meaningfully above the spot price quoted on your screen. That gap, called the premium, tends to widen when physical demand is strong even as paper prices are being pushed lower. When that divergence persists, it tells you something important about actual supply and demand in the physical market versus what the futures price might suggest. It's not a foolproof signal, but when physical premiums are elevated, even as spot prices fall, real buyers are willing to pay more than the paper price to get their hands on actual metal. That's a meaningful data point. If you're finding this useful, hitting the like button helps more people find this content, and subscribing to John Smith 02 means you won't miss these conversations. Now, let's keep going. When you look at COMEX silver inventory data, registered inventories have at various points been under pressure relative to the open interest in futures contracts. That means the ratio of paper contracts to physical metal available for delivery becomes stretched. Historically, that's been a precursor to volatility and, in some cases, squeezes, where the cost of delivering physical metal rises sharply. These dynamics don't resolve on predictable timelines, but the underlying tension between the scale of the paper-silver market and the physical market's delivery capacity is something serious investors need to understand. On the supply side, silver supply is not infinitely elastic. Silver is primarily a byproduct metal. The majority of newly mined silver doesn't come from dedicated silver mines. It comes as a byproduct of mining copper, zinc, lead, and gold. That means silver mine supply is not primarily controlled by the silver price. It's controlled by the economics of those other metals. When copper prices are high, miners produce more copper and silver supply rises as a byproduct. When base metal mining slows, silver supply tightens. This byproduct nature means silver supply responds very differently to price incentives than a primary commodity would. A sustained period of strong silver demand doesn't necessarily call forth a proportional supply response, and that matters when thinking about the medium and long term. Here's a useful mental framework. Imagine a river. The current water level is the current silver price. There are forces draining the river lower: elevated interest rates, dollar strength, speculative short positioning, and risk-off sentiment in financial markets. Those are real and can push the water level down substantially in the short run. But underneath the surface, there's a growing underground spring fed by industrial demand, the energy transition, semiconductor and technology consumption, and a supply structure that cannot rapidly expand. That spring doesn't move the water level every day. You can't see it directly on a price chart. But over time, if it's strong enough, it eventually refills what's been drained. How far can prices fall before the structural support reasserts itself? How long can financial headwinds overwhelm physical demand fundamentals? Those are genuinely hard questions, and confident, specific answers are a sign someone is oversimplifying. What we can say is that historical crashes from structurally different demand environments don't necessarily predict what happens in one where industrial demand has reached the scale it has now. The 2011 crash happened in a very different industrial context. The 2013 correction happened before the solar and EV boom changed the demand equation. Using those episodes as exact templates for predicting 2026 may lead you seriously astray. At the same time, macro forces are real and have shown the ability to suppress precious metal prices for extended periods. The 2011 to 2015 decline took silver from nearly $50 to around $14. That was a brutal multi-year grind, even as industrial demand was growing. The structural demand story does not immunize investors against extended drawdowns. History is very clear about that. Re-accelerating inflation drives renewed interest in hard assets. Slowing economic growth creates pressure for monetary easing, historically very supportive for silver. Escalating geopolitical tensions bring safe haven flows. And if industrial demand from solar and EVs keeps growing faster than supply can absorb, the physical market gets progressively tighter in ways that eventually show up in price, regardless of what paper markets are doing in the short term. There's also the gold-to-silver ratio worth noting. It measures how many ounces of silver it takes to buy 1 ounce of gold, historically averaging between 50 and 70. When silver is under pressure, the ratio spikes, meaning silver becomes cheap relative to gold. Elevated ratios have often, though not always, preceded periods of silver outperformance as the relationship mean reverts. The ratio has been elevated recently, which analytically minded investors pay close attention to when thinking about relative value. Now let's connect all of this to what it means for everyday investors. If you hold silver, or you're considering it, what's the honest takeaway? Silver remains a high-volatility asset with a credible long-term structural demand story that is stronger than it has been at any prior price crash in history, but with real short-term headwinds that are also genuine and shouldn't be dismissed. That's not a comfortable answer because it doesn't tell you what price to expect next month. But it's the truthful one. Serious investors in moments like this don't try to time the exact bottom. Bottoms are almost never identifiable in real time. They ask whether the current price level reflects a compelling risk-reward given a longer-term view of fundamentals. And that's a question each person answers based on their own financial situation and time horizon. What history does tell us is that some of the best long-term entry points come during periods of significant price weakness, when fear is highest. The 2008 lows and the 2020 pandemic crash both felt catastrophic in real time. Those who looked past the immediate fear and focused on fundamentals over a longer horizon were generally well rewarded, though they needed patience and financial stability to hold through continued volatility. The risks to the bullish structural view are real and need to be named. A significant global economic slowdown could hurt industrial demand from solar and EV manufacturers. Technological changes in solar panel design could theoretically reduce the silver content per panel, and research in that direction is ongoing. A sustained period of high real interest rates could continue suppressing investment demand. Government policy changes around energy transition subsidies could affect the pace of solar deployment. These are legitimate risks. The structural demand story is compelling, but it isn't guaranteed, and any position in a volatile commodity like silver needs to be sized with the real possibility of further short-term pain in mind. What you shouldn't do is make decisions based purely on fear or purely on excitement. Silver markets draw both emotional extremes, and neither leads to good outcomes. The people who panic sold in March 2020, when silver crashed below $12, missed one of the most remarkable recoveries in the metal's history. The people who bought into the hype at $49 in 2011 without understanding the speculative dynamics, found themselves underwater for years. Neither outcome is something anyone plans for. Both are predictable consequences of letting emotion drive decisions rather than analysis. The framework that matters most is simple. Understand what you own and why you own it. Know the difference between a temporary price decline driven by financial market forces and a fundamental deterioration of the underlying demand story. Right now, the fundamental demand story for silver appears intact and arguably stronger than it has been during any previous major price correction. That doesn't guarantee a specific price outcome on any timeline, but it does suggest that the sustained secular bear market that followed the 2011 peak, when the industrial demand base was far smaller, may not be the right template for what comes from here. So is this crash a trap or an opportunity? The honest answer is it could look like either one depending entirely on your time horizon, your entry point, and your ability to hold through volatility without making emotional decisions. For short-term traders trying to catch a bounce, the risks are very real and the timing is unknowable. For longer-term investors who understand what they're holding and why, who can accept the possibility of further short-term weakness, and who believe the structural demand story plays out over years rather than months, this environment presents a fundamentally different picture than the headline suggests. Markets are not always right in the short term, but they tend to price in reality over longer periods. The reality of silver's industrial demand story in 2026, built on the energy transition, solar, EVs, semiconductors, and a supply structure that cannot rapidly respond, is a more supportive backdrop than silver has had at any previous major correction. That's worth understanding clearly, whatever you decide to do with it. Thank you for watching. Drop a comment below and subscribe to John Smith Zero so you don't miss what comes next. Until next time, take care of yourselves and keep thinking clearly.